You are trading. You think you have the right direction in the market, and all of a sudden the market does the exact opposite of what you expected it to do. Breaking market structure, doing all kinds of weird things, you potentially breaking your monitor out of frustration. Now, here are 3 steps to avoid just that and how we can actually make money from it. So, diving straight into it. Section 1 is step number 1. In order for us to know what a liquidity sweep is, we need to be able to define the words liquidity and sweep. So we are on the same exact page. So what is liquidity? Whenever we refer to liquidity in the chart, that's going to look like a swing high and a swing low. So on the right side of our screen, we see this swing high right there, which is just simply said again, the 3 candle pattern. 1, 2, 3. Once that 3rd candle closes, it creates that swing high right there. And the exact opposite, it's also a swing low. So here at the bottom, we also see that swing low right there, 3 candle pattern. That is swing low where liquidity is located. So above swing highs, we have liquidity, and below swing lows, we also have liquidity. Because what is above swing highs and what is below swing lows? Trapped traders. So what does that actually look like in a chart? We're going to go over Forex, crypto, and indices / futures as well. Where right here, what do we see? What is this low that I'm currently marking? That is a swing low, right? Below that swing low is where we have trapped traders. There's liquidity there. Why is that? Because people are trying to get involved right there with their sell stop, trying to catch the momentum in the market going lower. But there's also other traders, because people that bought the market right there also would place their stop loss below swing lows right there. So in other words, the liquidity that we have below that swing low is orders in the market. Why? Because those orders can get matched with our own orders. For every buyer, there needs to be a seller. For every seller, there needs to be a buyer. So if we, and when I refer to we again, central banks, big institutions that want to buy right there, what do they need? They need willing sellers in the form of sell stop, and that stop loss of a buy order is also a sell stop. So if those people get taken out, then the central banks, the bigger institutions that move the market, can get involved right there with their buy orders. That is liquidity. And the same is said, of course, about swing highs. This swing high right there is where we also trap traders. We trap traders in the form of buy stops right there, but not only buy stops, because we also have people that took a sell order right there and placed their stop loss above that swing high sitting right there. Those are both, again, buy orders. And we can match that with sell orders. So we sell to willing buyers. Well, of course, quote unquote, willing, because simply said, they are just a target and they are just getting trapped. Where it happens in the Forex market, on for example, Euro US dollar, it also happens on the crypto market, on Bitcoin, for example, right here. Look at this high that we have to the left. That swing high is where we trap traders to then move to the opposite side. Now, where it also happens on Bitcoin and crypto, it also happens on the indices, the futures market. Here on NASDAQ, what are we actually seeing? We see this right there being a swing low. We come below it and we move to the opposite side. The exact same thing happens on every single market you can think of. So the first step is currently quite clear, right? We understand what liquidity is and what it looks like. That is important because otherwise we don't know what is actually sweeping, of course. That is where step 2 comes in, because step 2 is what we need to understand. We are sweeping liquidity. Then the second step in section 2 is what is a sweep. The first step in understanding what a sweep actually looks like is that it starts with an FVG, fair value gap, moving into the liquidity. Then the second step is an opposite fair value gap, an opposite FVG. So if we take a look at the right side of our screen, we see this swing low, that red line right there. We would want to see a bearish fair value gap coming into that liquidity right there. And then on the next few candles, we would want to see an opposite fair value gap. What is opposite of a bearish fair value gap? a bullish fair value gap. And that overall creates a sharp turn. So taking a look again, first at Euro US dollar, then we had this swing low right there, and we also had this swing high. Do you notice similar characteristics? We first, and the first step again of recognizing a sweep, we have a fair value gap going into the liquidity right there. And the second step is we have a fair value gap on the opposite side, meaning bearish fair value gap, we have a bullish fair value gap, a small fair value gap, but that is a fair value gap right there. Once this bullish fair value gap right there has been created, this overall section, the fair value gap, the liquidity taken right there, the bullish fair value gap, is known as a sharp turn, as an ST, as we like to call it. A sharp turn is an extremely powerful reversal pattern, where if we look at the swing high, we see the exact same thing right here. We have the swing high, we have a fair value gap going into the swing high. That is important, right? Why is that? It's fake momentum, it's manipulation right there, where people are getting trapped. They think it's going higher, but it's doing the exact opposite of what they expected it to do. After that, we see this opposite fair value gap. Bullish fair value gap, bearish fair value gap, creating a sharp turn. It's important to note that when we sweep a swing high or we sweep a swing low, we don't stay above it for a very long period of time. So a sharp turn, again, indicates that it's sharp, right? We're not messing around right here and staying above it to then continue lower. No, because when people are trapped right there, they should not get a chance to be freed, because that is where step 3 comes in. In step 3, it's very important to understand that they need to be trapped. So we don't stay long above that swing high when we sweep it. And also the fair value gap going lower should again be below that swing high. The same for a swing low right here. When we are sweeping that swing low, we have the fair value gap going into that liquidity, into that swing low. Once we sweep and we come back above this swing high right there, that is the exact spot where you would want to see a bullish fair value gap be created. So above the swing low right there, and the bearish fair value gap below the swing high. Then on Bitcoin in the crypto market here, we saw this high right there getting reached. After that, if we take a look at the daily time frame, we see what? We see this daily fair value gap going into the liquidity. Afterwards, we see this daily fair value gap going out of the liquidity. Meaning, first step, fair value gap. Second step, opposite fair value gap right there. That creates the overall sharp turn right there. The reversal pattern that we are looking for. Now, something that you might notice is when we sweep highs or we sweep lows, we wick it, meaning that we only wick right there into the liquidity pool and then we continue lower off of that. So the pattern that we see here, the fair value gap higher and the fair value gap lower, is the same thing happening on the lower time frame inside just a single wick right there. So inside this wick right there, if we go into the 1 hour time frame, then here we have the same exact weekly swing high. We have the daily fair value gap higher and the opposite fair value gap right there, creating a daily sharp turn. Now, if we remove those gray boxes, then what are we seeing here? Weekly swing high again. We have bullish fair value gap going into the liquidity, bearish fair value gap coming out of the liquidity. So the long wick we saw on the daily time frame was a 1 hour sharp turn as well. This is important to understand because you don't necessarily need to go into the lower time frame to then actually see a sweep happening. Because right here on Nasdaq, we see this low right there getting swept as well, but not your typical fair value gap in, fair value gap out, because here on Nasdaq, we see again the sweep, but not your typical step number 1, fair value gap, then the opposite fair value gap, then the sharp turn. Well, yes, it is there, but it's a little bit high right there. So this wick already told us enough. It already told us exactly what we would want to see. Because this wick on the 1 minute time frame is what? That is simply, again, what we demanded of a price. The fair value gap coming into the liquidity and the fair value gap coming out of the liquidity right there. The opposite fair value gap. Creating a sharp turn here on the 1 minute time frame, which was also seen by the long wick on the 15 minute time frame. So now we know what liquidity is, what a sweep looks like as well. So the third step is right here, section 3. What is the target and how can we now capitalize on that exact move? So the target is the opposing liquidity, meaning the swing low that we see on the left side of our screen, indicated by the green line right there, is getting swept. And when we sweep that swing low, the opposing liquidity is just the opposite liquidity, meaning swing low, what is the opposite? A swing high. So the red line that we are seeing right there is the swing high. That is the opposing liquidity, the first swing high that we encounter. So on Euro US dollar, once we sweep this swing low right there, we have the fair value gap going into the liquidity, the opposite fair value gap right there, creating the sharp turn. The opposing liquidity is the first swing high that we actually encounter. What is the first swing high? This right there. After this swing high, we see the same thing happen again, which is very interesting because we have a fair value gap into that, we create the sharp turn again, and that sharp turn right there is where we now target the opposing liquidity, which in that lag higher was this swing low sitting right there. And that is our target. Now, before we go into how to capitalize on this, how to make money from it, we need to understand what the targets are on Bitcoin and NASDAQ as well. So looking at Bitcoin, the swing high right there is a weekly swing high actually. So what is the opposing liquidity based on the weekly right here? Well, that is the swing low in the form of this right there. That is our opposing liquidity. So on the daily, we go into the daily and we mark out our sharp turn. And that sharp turn eventually targets this swing low sitting right there. That is the first area from the opposing liquidity, swing high to swing low. And here on NASDAQ, we are sweeping this swing low right there. In this lag lower, what is the opposing liquidity? It is indeed, you guessed it, that swing high sitting right there. That is the first target. And afterwards, we can see we are not sweeping this high, right? We don't have the characteristics right there. We don't have those steps of sweeping that high. So what do? We target the next highs and eventually this high right there. And again, how we can see that is all things we are going to go over in next episodes as well. So we understand what the target now is. Now, perfect. We understand the 3 steps to be able to actually make money from this. In section 4, we are going to go over what are the 3 steps and how can we now actually get involved and make money off of that. First step being liquidity. We understand again on the right side of our screen, we see this green line, for example. We understand that is liquidity. Once we come into that and we create a sharp turn, fair value gap into the liquidity, fair value gap out of the liquidity, we target the opposing liquidity. That's the third step. Those are the 3 steps, simple steps to be able to identify a sweep. Once we sweep this swing low on Euro US dollar, we have the sharp turn. We create fair value gaps going higher. Now, we do not come into those fair value gaps before we actually reach the drawn liquidity, meaning we reached the opposing target right there, the opposing liquidity, before we actually came back into a fair value gap. Now, what do we see when we sweep this swing high? We again have that sharp turn. The bearish fair value gap of that sharp turn is exactly what we can continue lower from. So what you can do is here on the 4-hour, this in itself is already an entry to continue lower. But in that 4-hour fair value gap right there, what is that? That is where you can go into the 5-minute time frame, into a time frame of your liking, and you can see the exact same thing. And that then becomes your entry pattern. And that is exactly what we are going to go over as well in next videos. So in itself, this is already an entry to target the opposing liquidity sitting right there. So if you're a swing trader, then this right there is a great opportunity for you to get involved. If you're a day trader or scalper even, then that 4-hour value gap right there would allow you right now to go into the lower time frame to look for your entry pattern in that 4-hour value gap. All right, so on Bitcoin, we were sweeping this liquidity that high, targeting the opposing liquidity in the form of that low right there, On the daily time frame, what did we see? We saw a sharp turn. This sharp turn right there leaves behind again that bearish fair value gap. In itself, that is already an entry to continue lower from. If you are a position trader, for example, great entry. If you do not want to position trade and you want to be a day trader, a scalper, then what is that? Then this right here, this daily fair value gap, is right now your PD array, your premium array, to go into the 15-minute time frame, the 5-minute time frame, to look for your entry pattern to continue lower off of that. Where then the target still remains this target right there, the opposing liquidity. And here on NASDAQ, what are we seeing? We see this swing low getting swept right there. Now this is a little bit more difficult, right? Or a little bit more different, let's call it that way. The most simple thing you can do right here is wait for a new 15-minute fair value gap higher. For example, that fair value gap to enter off of that, or even the next fair value gap sitting right there. Or the order block that we have right there, covering the swing low to continue higher off that to target the opposing liquidity in the form of that high, that swing high right there. Simply said, following the fair value gaps higher. Then eventually we see we are not sweeping this high, so we are continuing higher, and the next target can again be this swing high right there. Now, just for your information, if it does intrigue you, every single thing that we went over right here was either called in the free Sunday weekly forecast on this YouTube channel, or it was called in a live session in the Discord in the money making team, which is of course on arjo.io. What I would love for you to do is study this, and feel free, for example, to go over the dollar right there, the DXY, to see what happened in this exact week. And then once you've studied that, we can move on more easily to the next episode as well. All right, perfect. Thank you.